Hey everybody, good afternoon and welcome to today's coaching. Sound check please. Hey Ted and Lee. Hi everyone. Anybody out there? Let me know if the sound is good. Okay, great. Okay, well, welcome everyone. We'll start with Ted's question. I'll read it for those that are going to be watching the recording later. The question reads, would you please explain which trades are okay to kill before the stock hits the stop? And is it a good idea to do that? By doing that, sometimes I get much better results and sometimes I miss big trades. Are there rules to follow? This is a really, really good question, and I'm so sorry to say I don't have an answer for you. We are discretionary traders, and oftentimes we have to, I don't act on, I just act on experience, on intuition, on what I see is happening. I don't have precise rules for it. But you can come up with some guidelines or some, we can come up with some things to consider. And these are: one, just know that if you ever get into a trade and the stock takes out the entry bars low, again, you play a breakout, you play a buy setup, whatever it is. I mean, what did I like that failed? TPX, right? I think it failed. If a stock takes out the entry, this was, let's say, the entry bar. If the stock takes out the entry bars low, there's probably an 70 to 80% chance that the setup will fail. So again, knowing that the play would fails 70 to 80% of the time if once the entry bar's low is taken out, if you're playing long, or the entry bar's high is exceeded if you're playing short, that gives you the the right to raise your stop to the entry bar's low as soon as you get into the play, and as soon as that entry bar's low, as soon as that bar finishes forming. This is why we don't put the entry under the bar's low, because we don't, when we get in it, sometimes always it's still forming, right? So we don't know exactly what the low is going to be, but you can always raise the stop to the entry bar's low. So that's number one. So are we clear on that? I mean, were there any trades that didn't work? I didn't honestly do the BECN. I see that it went to 30 to 08, so technically triggered. I didn't even see it trigger. But look at this. Let's say this was the entry bar's low. I mean, this was the entry bar that got you in it, right? And instead of keeping your stop up here, just kill it over this bar's high. Does that make sense? Then you would have still lost money, but you would have reduced, you wouldn't have lost that much. So that's the biggest tip or trick that I can give you, is to use the entry bars low and high as a way to reduce your risk. Okay, but it's not necessarily always advisable. What if I was sure about a play? I was just really sure about it. Like, let's say, I don't know, just any play, and I still have it. If the play still has a declining 20 above it and it's just going sideways for now, is it a good idea to use the entry bars high as an exit? Probably not, because the stock is just going sideways. There's still resistance above. There's still a declining 20. You're really sure about it. You really like the setup. There was no hesitation, no doubt in your mind about the direction of the play. It just maybe needs a little bit of room to get going before it finally actually gets going. So it's not always advisable, but it often is advisable to use the entry bars high or low to exit your play. So does that make sense? That's the most important, or the biggest thing that you need to understand and take into consideration if you are looking to keep your stops really small, which I do. I do all the time. So does that make sense, Ted? Let me know. Just want to make sure we're on the same page. Okay, so that's the most important thing. Number two, understand that you can't have yin without yang, or whatever, pleasure without pain, or you can't have you can't have it both ways. You can't say, well, I would like to kill my plays quickly if they go against me and make the big money when they go in my favor. You're not going to have it both ways. For example, today on the CCL, I'll just give you an example. If I was trading it, now Ifan had a call on it, traded it perfectly. But look, it got 1 cent from the stop. If I was trading it, I definitely, P5, right? I need to go CCL. I definitely would have taken half here somewhere. Does that make sense? This way, if the trade goes against me, then no problem. The play I think that Ifan called was here short, right? I think, or here short. I don't remember. Stop right here. And yes, it wasn't that much, but I definitely would have taken half rather than lived through this. But so I'm more, you know, I like I'm more of a bird in hand than two on the tree kind of guy. So, but look, if I got out of it here, I might have made an R, right? But look, I definitely wouldn't have stopped out, and this came very close to stopping out. I think 1 penny from stopping out. But look, he didn't kill it, and I don't know where he ended up exiting here on the breakdown this afternoon. So you can't have it both ways. You can't be the kind of trader that likes to trail really tight and still be able to make to get the place to target. Most of the time, it doesn't work like that. Unless, which is not easy, unless you give yourself permission to get back into the play. And that's okay to get back into the play, but it's not always easy because sometimes the setup is not very good. Like this setup might have not been good enough to get back in it. And if the play goes against you by this much, you might already start questioning the play and lose confidence in it. So there is no alternative to knowing what type of a trader you are. At the mentorship, not this last one, but the one before, I did an exercise, and I said we had an exercise where we said, just so we know who we are as traders. For a lot of the trades, not all of them, for a lot of the trades, I gave them two alternatives or two ways to manage. I said, for those that want to manage tight, here's the stop. For those that don't mind the rally and to live through a rally against them, here's what you should do. And I said, I recommend you take I said trade these with small size just so you can really figure out who you are as a person, as a trader. Are you the type that likes, again, bird in hand or two on the tree? So what is it? Remember Ryan? Ryan used to like to hold, but he often took stops after the play had already been up 1 or 2 hours maybe. Well, I never turn a 2 hour winner, even a 1 hour winner. I rarely turn it into a loser. But sometimes a 1 hour winner could have also been a 5 hour winner if I hadn't trailed it so tight. So you just have to know your style and who you are as a person, your pain tolerance, what your preference is, and really be uncompromising when it comes to trading in alignment, in sync with who you are as a trader. Be very uncompromising. And understand that if you're gonna be tight with your stops, you're gonna miss out a lot. I mean, or you're gonna miss out, not miss out, but you're gonna miss out on some of the big moves. On the other hand, you're also gonna have very small losses, and you're gonna have more wins. Does that make sense? So up to you. It also depends on the market environment. Right now, I think, not just right now, but in general, the markets are very efficient. Things don't get out of whack easily. I mean, of course, there are exceptions to the rule, but things are very efficient. They drop a little bit and they go right back up. They drop a little, they go back up, or they rally and then they get slammed. It's rare to see something that keeps going, like the D car or something like this all day, right? It's rare. So if the market is very efficient, you're probably going to make more money by being tighter or tight rather than loose with your management. But the most important thing to understand is is to know what style, what it is that suits your personality, what it is that suits you. There are many different ways to manage pivots, bar by bar, uh, pivots on multiple time frames. You can even manage off the level 2 like I often do with the scalps, just off the level 2. You can manage based on a moving average. Which one is right, which one's wrong, it depends on your style of trading, the type of trading that you do, and it also depends on you, the trader, the individual. All right. Right. Some trades I stay with until it stops out. Some trades I kill quickly. Most trades I don't take a full R stop. I mean, the vast majority of my trades, I do not take a full R stop. In fact, when I did last time I looked um, at my stats, my average loss was a quarter R. My average loss was 125 bucks. Was a quarter R. Okay? My average loss is a quarter R. That's pretty good. Now my average win was 4 times that, but it does, but it doesn't mean it was, 2 Rs. I mean, it doesn't mean it was 4 Rs, right? It's just that it's 4 times my average loss, which is fine. It's not 4 Rs, but it's really 4 Rs still because my risk is very limited. It's very small, or my losses are small. Does that make sense? So, you have to think about it, and then over time, you will be able to figure out concretely almost which trades you can kill and which ones you should never kill or should not get really tight with. Generally, if the stock has momentum, if it's a momentum type play, then you can just go bar by bar. Because if once that momentum changes, then it's probably over. Does that make sense? If the stock is not a high momentum, then you don't want to get really tight and go bar by bar if it's basing or right. But once it starts to go like what was that EOLS yesterday? I think once it starts to drop like this with every bar high being lower than the prior bar's high, sure, go bar by bar. And maybe you're out there at the bottom. Great. But while it's here, let's just say you got in it here and you can't follow bar by bar. I mean, bar by bar would have worked in this case, but I'm just saying when the stock is basing or here, let's just say you got involved in it, long or short, doesn't matter, whatever it was. Here, that's not a momentum stock. Over here, that wasn't. So, but um, once you have this kind of a move, or you see that the stock is respecting the prior bar's highs or lows, then that's when you can go tight actually. All right. And another thing to also keep in mind is what kind of a move were you expecting for the stock? Like if you were expecting the stock to drop to you got in it at 22, you're expecting it to drop to 15 bucks and you start going bar by bar here at 22 or 21.50, that's a mistake because you got into the stock thinking it was going to drop to 21 to $15, right? Let's just say. And then you immediately started going really tight. So you have to make sure your management also aligns well with your goal for the trade, with the target, with where it is right now in relationship to the expected target, number one. Number two, it aligns well with the, with the duration of the stock. Like, was this a scalp? Was this an all-day hold? If you're trying to hold this for the entire day and close out of it, at the end of the day, then going bar by bar, obviously that's going against what your goal for the trade, right? So, so I try to keep it simple like this, but I don't have a hard and fast rule about when I can kill and when I can't. Honestly, I do have some rules in my trading plan around that, but I don't follow them very closely. For example, if it's a market related play, I can always kill it if the market breaks the 5-minute trend. Or if it's a market related play and the market reached target and my play didn't reach target, then I can kill it or trade it bar by bar in the 1 or the 2-minute time frame. What else? So, I do have some early exit rules, but I just don't find them sufficient to deal with the dynamic market. And this is why trading plans, for the most part, don't really work very well, because it's just ink on paper versus the market is dynamic, is moving, is different. It's the same, yet it's different from day to day, from moment to moment. The trades that you take might look similar, might look almost the same, but yet they're different. And they're different also based on the market environment, not just different in terms of being a different stock, but also in terms of the day you're taking them, what's happening with the market that day. And what else was I gonna say? So yeah, so I find trading plans wholly insufficient, um, inadequate for to make, when it comes to the application of the trading plan. It's just, no matter how much detail, how much information you put in it, it's just going to be inadequate. But I'm not saying this to discourage you from writing a trading plan. On the contrary, I think it's really important to write a trading plan so you know what it is that you're supposed to do during the day. What it is you're supposed to do in the morning, in the afternoon, your daily routine, your, certain money and risk management rules. All of that does need to be addressed in a trading plan. And most of all, I think trading plan, trading plans, writing a trading plan, it gives you the chance, the opportunity to put your thoughts on paper in a cohesive, uh, in a systematic way. Okay, without being able to actually verbalize or write your trading plan, then I think then you think you know what you're supposed to do and you know exactly what you're supposed to be looking for, but you don't really know how how much you're lacking until you start writing it down. Okay, until you start describing it, you'll realize, oh my God, I thought I knew exactly what the pattern looks like, and I do, but I don't know the detail. And so it's extremely important to actually write a trading plan. But again, having a trading plan, if I were to give you my own trading plan, does that guarantee success? No way, no how. Otherwise, I'd just give it to everybody, right? But it doesn't at all. Okay. All right. I hope I was able to answer that question. Next is Lee. Curious as to day or swing trading. What is your daily routine? How many hours do you work typically? Okay. Uh, I don't know. It's for day trading. So let's just run through the routine. For day trading, first thing I do is I look at the market just to figure out whether we're bullish, bearish, based on where we're gapping to. Market usually gaps a little bit. So I look at the hourly, the daily chart, and the pre-market. So and I come up with a game plan for the open. Okay. Second thing I do is I start scanning for the gaps list. So I do that in the pre-market, and that takes me about, and then I have to, I have to put the gaps on charts. I have to figure out what I'm going to be doing first thing in the morning versus later in the afternoon. Have to post the gaps list to the room. Um, so that takes me about, the whole thing takes me an hour. It doesn't even take me an hour. It takes me less than an hour. But it also depends during earnings season. And if I wasn't doing it for the room, then it would be just like, it would take me half the amount of time, probably. So in the morning, and then after that, as a day trader, today I already scanned for swings. I already adjusted my stops. I already responded to all the outstanding emails that I had from the weekend and the last 2 days. So I already did all of that during the day, but I also was available to take advantage of day trading opportunities if they were to come up at any time during the day. So as a day trader, I am usually available and during earning season busy trading the entire day. So 6.5 hours during the day and an hour before, that's 7.5 hours. That's a full-time job. But again, when it's slow like today, I do other things. I try to accomplish other things as well. So it's not, I didn't spend really 7.5 hours day trading today because I did other things. But when I'm busy day trading during earnings season, yes, it's an 8 hour job, 8 hours per day job. Okay. If you have to track and annotate your charts and review your trades, that's another hour or 2 hours after the close. Okay. As a swing trader, what I do is I scan my entire stock universe on the weekend, and I scan daily and weekly charts. And I have a carryover watch list from the week. I go over that. I update the swing trading spreadsheet for the SSD program members, right? I do all of that and I call the plays, and that takes me, I would say, half a day. I don't mean 12 hours, I just mean like 4 to 6, probably, yeah, probably 5 hours. It depends. 4 to 6 hours. It depends, but about 4 to 6 hours on the weekend. During the week, uh, I have a watch list that I generated on the weekend, and I rescan that. I go over it on a daily basis after the close, and I have to also adjust the stop for open positions, right? So that takes me, after the close, takes me about, I mean, right, like today, I think it took me about, because I haven't yet posted the new trades, it took me about 45 minutes, so it takes me between 1 to 2 hours on a daily basis. For swing trading, 1 to 2 hours. On the weekend, 4 to 6. So that's swing trading. Now, again, my time is, you can, like, if you can do it in less time if you weren't running also, you didn't have a room or a program that you were running. So it takes me more time to deal with that, of course. Because if I were trading by myself, I wouldn't be posting the plays. I would just be entering them into my platform versus posting them online. So swing trading, let's say 1 to 2 hours a day, right? Because you have to scan and find the plays and enter the orders. Swing trading, 1 to 2 hours a day, 4 to 6 on the weekend, and day trading is a full-time job. But I also want to say that when it comes to day trading, um, there are times when really, if I didn't have to be in the room, I would only show up the first hour, trade the first hour, trade the last hour, and that's it. And not worry about making, you know, making the small money in between, because most of the time, it's very hard to make money at lunch. Okay, so does that answer your question, Lee? Let me know. I'm as efficient as the market. No way, no how. I wish. But yeah, the market is super efficient, which is unfortunate because when it's not so efficient, then you can take advantage of it. When it's efficient, then there's nothing to take advantage of, almost, right? So anything that's efficient, an ecosystem or anything in life that's efficient, then there aren't that many opportunities, or the opportunities are even if they are there, they're short-lived. If it's an efficient system, um, there's no, or if it's an efficient engine, it means it doesn't waste fuel, too much fuel, right? So the market is very efficient only because of technology, only due to technology being used in trading. If it's just people trading, it would be like it'd be we would see opportunities left and right. That's why back in the late 1990s, early 2000s, there were a lot more day traders back then, and a lot of people thought they were really good stock traders and they were making a killing. I mean, I've met many people who made a lot of money. Like I can't even begin to tell you, hundreds of thousands. I mean, I know of a trader that used to make not infrequently over $100,000 a day. Not infrequently. He would have at least once a month. He'd have $100,000 a day. The guy didn't know how to trade, but the market was very inefficient back then, and so it was just bonanza back then. Um, okay, gents, are you still working on intraday algos? How have they performed? Gents, disappointing as it may be, I have not run my algo much at all. Started running it last quarter, not this last quarter, the one before. So in the last quarter of 2018, and I just was overwhelmed because I had the earnings plays, day trading was great, and then swing trading, then the room, and the open house. So I didn't do it. I did do it with, I did run it, but on simulator mode, and I think, I don't remember if it 1600 trades, and the result was pretty great, but it was on simulator mode. So, and with real money, I did very little trading with it. So I do intend to use it for sure next quarter, this coming quarter, and then you can ask me in June how it did, and I'll tell you, okay? But yeah, I don't want to be, I mean, that's kind of stupid to have invested so much time and effort and money building an algo and not to use it. So I need to use it. It's just, it's a matter of finding the time. And I just last time I felt overwhelmed, so I decided not to do it. Okay. All right. Any other questions? Let me know. Okay. So there wasn't much to do today. Not much at all. I think I made $300, 300 something dollars. I closed out of my platform, but I did take a picture, so but there wasn't much at all to do today. It was one of the slowest days of the year, for me at least. What am I looking for? Looking for a picture of my P&L to see what I did. Um, oh, it just opened here. So that's what I did today. As you can see, the best trade was the VIAB, and that wasn't the biggest, but that's the best trade. I tried to, whenever I did the AMRS, the QHC, whenever I did that, I did it with by adding liquidity. So, so I should get a nice rebate. But that's my day. I mean, just nothing, nothing big at all. And so there was nothing to do, almost nothing to do. On the NEOG, I got filled 100 shares, and I tried 1,000. So this number should be 10 times as big if I had gotten filled, but didn't get filled. I don't know about you, if you caught something today. I thought today was just, wow. It was one of those days where we didn't have a good gaps list, and the gap ups didn't necessarily work in the morning. The gap downs, was there any gap downs that I really liked? Again, I tried to catch that NEOG, and I only got filled 100 shares. Looking at in my notebook, there were virtually no gap downs. So question on the EOLS yesterday on the 15, what made it okay to enter under 17 versus waiting for $22? Okay, so good question, Jen. So the first thing you have to understand is the right entry. So that's 22. Yes, that's 22. First thing you have to understand is the right entry. Look, if you like the pattern, if you think it's a nice looking pattern, then you have to always make sure that you're entering at or near the 20, because if you enter away from the 20, in this case right here, it means you're increasing your stop, but you're also decreasing your target. So let's say this was your target, right? So your reward to risk is going to suffer in twofold. As the stop gets bigger, the target also gets smaller. So it's a really big problem. That's number one. Number two, the right entry we know is at or near the declining 20. It's not, if you see two entries, usually like 80%, 90% of the time, the right entry is the one that's closer to the moving average, not the one that's farther away from it. But third is, if you get the narrow body bar, like in this case, I like the pattern, I got the narrow body bar, that should be the entry. So, I like the pattern, I like the daily, it was a transition C on the daily chart. So that should have been the entry, in my opinion. I gave this as an entry, and I gave 12 as an entry. I don't think I ever mentioned, oh, where's 12? It should have been 10. I don't think I ever mentioned, or it didn't even cross my mind to enter under 22. I don't think so. I don't remember exactly, but I don't think so. So that should have been the entry. Do you know why I didn't take it? Do you want to know why I didn't take it? Because the previous week, I had every day was up, down, up, down. I mean, it was a struggle for me last week. This week, yesterday, I was doing really well. I just opened this P&L to show you. I was doing really well, and I became aware of it right before I was about to, when I was considering the EOLS. I decided, well, I don't want to mess up my day. Last week, the more I traded, the more I messed it up. So I decided not to do it because of my P&L, which is exactly the opposite. I mean, it's just wrong. In fact, when you're doing well, that's when you should push it a little bit. Okay. So that's the thing. So that's why I didn't take it. Otherwise, I said that's the favorite short, and I said it multiple times. There was this. There was the ACAM short, which wouldn't have worked, and there was the PM, which would have worked, but small reward to risk. I mean, just a small drop there. And I said out of the three, before any of them triggered, the EOLS was the best, and then the same with the AXM. I said that's the best long, and I didn't take it, and it worked. But the EOLS was even better. So, that's it. The other thing is probably another factor that affected my decision was the spread. Anytime I see spread right now, it's such a turnoff for me. So it's very hard for me to take a play that's spready unless I am like beyond sure that it's gonna work. Okay? But when I see stock is spready and jumpy or something like this, then I just really get very defensive, or I get very conservative, I should say. I get very, very conservative. And truth be told, I mean, these days, at least half to 75% of the stocks are a little bit spready, a little bit jumpy, at least 75%, I would say, at least. There are very few stocks out there that aren't jumpy and spready. And you know why I gravitate towards the low priced, or I've been doing their low price? Because they're not spready, they're not jumpy, they're really liquid, and I can read level 2 on them really well. That's why. Do you think I want to be trading something like this? It's a $1 stock, a $2 stock? No, I'd rather not. I'd rather be trading a $20, $30 stock that moves a lot. But how many of them trade with the kind of volume that PTI did yesterday, with the kind of consistency, no jumpiness, and then when you want to get out, you can see the offer being, let's say you're short, you want to get out, you can see that the offer is shrinking slowly. So it was, let's say it was 50,000 shares on the offer, then 40, then 30, then 20, then 10, then you know it's going to get taken out. So you jump out. It gives you the time to get out. A lot of stocks, a lot of the other stocks, they don't give you the time to get out. They just flip. And they go from 2020 to 2030, and you just lost 10 cents. So that's my issue. So that's my issue. But look, I was talking to somebody today about it, just chatting, and I said, I'm just gonna do what I know is best for me, what I know makes money, and let the rest go. Okay, anything that's questionable that I know, I don't mean just a trade, I mean a trading style that is right now is tough to make money with, just kind of let it go and focus on what I know I can make money with. Okay, because this is a very competitive business, unfortunately, that we're in, because we're competing against machines. That's why, not because the other person on the traders on the other side of your trade are that good. They're not. For the most part, you're not going to find that many really knowledgeable traders out there. They're few and far in between. And I think we're pretty good in that department, but the problem is we're competing against Wall Street. Okay. Don, how many trades do you do a day, and how many trades do you feel is the most you like to be working at any one time? Okay, I average 7 trades a day. Now, that's my average. But look, a lot of times, so how many did I do yesterday? 1, 2, 3, 4, 5, 6, 7, 8. But I mean, sometimes I'm in it for just a mere second or two. Like, were these real trades? Probably not, right? So this was a real trade, and I took it 3 times. I had 3 plays on it, 3 or 4, to tell you the truth. AMRS was just one-time thing. So a lot of times it's like this for me, where yes, I average 7 symbols on my P&L per day, but oftentimes they're just, I tried it, didn't go, I got out immediately. So do you consider that a trade? Do you not? I'm not sure. So for me, no, those are just scratches. Okay? So that's me. That's what I do. And then how do you feel? How many trades at any time, at any given time, do you feel? So you feel is what? Let me just read it again. How many trades do you feel is the most you like to be working at any one time? So here's something. I just want to tell you something. When I am taking, not scalps, but day trades, this is a little counterintuitive. The more, the better. You know why? Because if I'm not taking scalp trades, I'm just taking day trades that I intend to hold for a while. When I have multiple at any given time, like multiple 4 trades, 5 trades at the same time, then I am very I'm less likely, I am a lot less likely to mess them up or mismanage them when I have multiple trades open at the same time. So I like to be working with four at a time, or so, four at a time, I would say. Not more than that, but four sounds really good. How often do I find four good setups at any given time? I mean, I can't tell you the last time I did that. I can't. It must have been like a year ago. Been a long time probably when I had four open trades at the same time. So, but that's what I've noticed in the past, that when I have multiple trades open at the same time, I tend to manage them really well because I'm not paying attention, so much attention to every little tick, every little bar on each, the trade that the stock makes. So that's me though. Some people can't even imagine being in more than one trade at a time, and it's not because they lack any smarts or they can't multitask. No, it's just that's their style. They like to do one thing at a time. So you have to know you have to know yourself, and just trade accordingly. At the open, it's these days at least, it's very hard to do more than one trade at a time because the moment you get in it, it flips right away. I mean, you saw that NEOG this morning when I said level 2 looks great, let's get in it. I got filled 100 shares, but that's about it. It's, I mean, did you see that? Beautiful, right? But if you didn't get out, what if you shorted it, right? And again, it dropped in this is 1 minute bar. That's $2 in 1 minute. That's $2, okay? From high to low, $2. If you didn't get out, well, in this case, it continued lower. But you had to actually, it went back up $2 in the next 2 minutes, more than $2 in the next 2 minutes. So a lot of times at the open these days, you have to, if the trade drops hard in your favor, I can't look anywhere at anything else because I'm looking to take half at least on that initial drop. I'm looking to take half. So it's really hard to manage to manage to get into more than one trade at a time at the open. But let's say later in the afternoon, the market puts in a nice 15-minute buy setup, and I find all these great 15-minute pullbacks, and I get in them. Then I can do four at the same time, and I'd be fine. If you tend to always take a full stop on your play when it goes against you, then obviously you can't take four. I rarely take a full stop, okay? So because if you take four and all four, let's say, fail, then you're down 4 Rs. That's a lot. But I rarely take a full stop on a play. So like I said, I can do 4 and I would feel even 5 and I would feel totally comfortable personally. Okay, what else? Any other questions? Sure, Jennifer, you're welcome. Let me know if you have any other questions. Let me know. Okay. Tony has a question. All right, sounds good. Do you put your stops in the system or just hotkey them when you want out? If I have 4 different plays open, you bet I'm going to put my stop in the system. Okay, if they are scalps, I don't put my stop in the system. Usually, I'm just watching level 2, trying to watch level 2. But if they're like something like the EOLS, it's not a scalp, it's a real setup on the 15-minute chart, then there's no reason not to put your stop in the system. There's no reason. Okay, but again, if it's a scalp or if I'm looking to managing it really tight, then then yeah, I will. I'll just watch it. I won't put my stop in the system. Okay. Also, if the play is stopping out, and I see it is about to stop out, I usually don't. I usually exit manually. I don't wait for my stop to get hit. It's not that I don't wait for my stop to get hit, but I can get out faster than the system actually tagging me out. I can see I can get out just as soon as the offer reaches my stop, and I can just jump out if I'm short, or as soon as the bid reaches my stop, and then I'm out. So usually if I see that the trade is stopping out, I will get out manually. Also, targets, no, targets definitely I don't put in the system ever. If you walk away, sure, you should put them in the system, probably. But for targets, I don't put in the system. I like to, if I'm in a play and it's a reaching target, I like to still manage it really tight, and then go to the level 2 and make sure that as long as the offer, the ask is not being taken out, is not being lifted, then I would stay in it and then try and squeeze out more of the play out more than the target. In this case, somewhere there, maybe at the bottom is where I would have gotten out if I was in it. Okay, but targets I don't put my order in the system for. When you exit trade before the original stop, how often do you re-enter the trade if it goes in the desired direction? So here's the thing, gents. So here's something that is, I think, good for everybody to know. So here's the thing. Let's just assume the trade this wasn't the entry, this was the entry. Got in it right here under the green bar and start to go back up. I might get out of it right here. Okay, I might, just based on my experience, intuition, I might get out of it. And then as it approaches the stop and starts to come in, I would get back in it right here at the stop. So the question is, when you exit the trade before the original stop, how often do you re-enter if it starts to roll over and go in the desired direction? If I get out early and I think I think the trade is still valid, still looks good, I always look to get back in it, but I always look to get, so what I do is when it's approaching the stop and it starts to come in, I enter under the 1 minute bars low. Does that make sense? So if I were to draw this for you, let's say I got into a trade, let's say I got into the trade here, short, under this bar's low, and started to go up. Okay, I'm out. Let's just say I'm out. And then, but I do think this is a good trade, and I do think this is going to continue lower. Goes up, right? Starts to go up, and then right where it's supposed to stop, it starts to come in. Then I get back in it here and put the stop there and hope that it continues. And if it stops, then I just lost a little bit. Okay? So I do like to get in at the stop. If the pattern doesn't fail and it starts to go in the desired direction, like you said, go in the right direction. All right. What else? Any other questions? Good stuff. Good questions, guys. I wasn't sure I was gonna have any questions today. BECN, was that the failed trade? Yeah. So you really only stay in a play if it starts going in the direction right away. And no, I didn't say that. I said if it's a momentum play, then usually yes, I don't stick with it if it starts to go against me. But if it's a play that I know it needs patience, like like this one, I didn't think, let's just say I decided it wasn't ready to, I didn't think it was ready to go, but then I was sure it wasn't gonna fail. I was sure this resistance was a brick wall. It wasn't gonna fail, and I knew it wasn't ready, but I was afraid to not get in it here and then end up missing out on it. Then no, I would give it the room. But if it's a momentum play, and then yeah, I usually just go bar by bar from the get-go, almost from the get-go. Okay, like this one, if I was in it then I definitely would have killed it over 25 for sure, 100% right here, over 25. Okay? But again, Stephen, I don't want to teach you guys bad habits because for a lot of traders, it's probably better to stick with the original stop. And I don't know if it's better or not, but I'm just saying, I don't want you to start trading on intuition and and over trading and getting out and in and out too many times. This will come later. For now, just make sure that you know what you're doing, you know what you're looking for, and you do it with small share size. And then as you gain experience, you start to make realizations. You start to really notice certain things. Okay, and then you start to act accordingly. Okay, Stephen, then you have to fix something. You have to there's something wrong and you have to fix it. Why don't you start with, let's say, going by the rule that I gave you, the tip that I gave earlier, which is get out if the entry bar is low, gets taken out. If you're long or the entry bar is high, gets taken out. If you're short, just get out and see what happens. I bet you will save a lot of money. I don't know for sure, but I have a feeling you're going to end up saving a lot of money if you do what I just said. And see how that works out for you. Okay? Sure. Look, in environments where the batting average is low, where we don't have this kind of market environment, let me show you. So let me show you the cues. 80% of the bars, 70% are narrow range bars. Almost 80% of the bars are narrow range bars. Okay? Versus this kind of market environment, I think in this market environment, the doji bars each day, it pays to be very nimble. So if you're going to be nimble, what that means is you're going to be tight if the trade goes your way, so you're not going to make a lot of money per trade on a trade by trade basis. But if that's the case, if you're not going to make a lot of money if the trade goes in your way, then you should not lose a lot of money if the trade goes against you. Does that make sense? So you should be nimble on both directions, whether it goes in your way, your favor, or against you. So in this kind of market environment, yes, you should be really tight with your stops. I mean, or get out quickly, right? In this kind of market environment, you want to see if you can hold because those are big bars and you can make big bucks if you can catch the play and hold. All right. This used to be the norm almost. Not this much, but almost used to be the norm before technology took over Wall Street, basically. Okay, that used to be almost the norm. If you don't believe me, just go back to even just 10 years from now. You don't even need to go back further. Of course, the further you go back, the more you'll see that to be the case. I mean, look at 2000, sure, 2007, 8, 9. We had the crash. But even look at 10, 11, 12, maybe not so. But most years were still, very fluid most days. Okay. Okay. All right. So I'm doing a lesson series on this is, so just don't quote me on this. Don't tell anybody I said that. This is all the advertising that I do for the room. You might not know it as advertising, but that's what it is really, is these like Facebook and YouTube videos. And I'm not a sales guy by nature. It would be so much easier if I was. It's funny, Ifan and I always talk about it. We say we're not salespeople at all, right? So what I do is I put out really valuable information so that people can see what it is that we do in the room and the level of education that that I have, and that, I mean, the level of knowledge and the level of education that is shared in the room, so they can, you know, they can sign up if they like what they see, basically. The problem is, there's one big problem. I compete with all these, you know, all these scams out there. Unfortunately, it's the truth. I didn't know it, just like you. I didn't really know it until kind of recently. So I have to compete with all these scams, and I'm not good at sales. I'm just not a sales guy at all. Never was, never will be. So what I do is I try to, again, put out some good educational lessons, information, and hope that it clicks with some people that are not looking for, that are actually looking, scratching a little bit beyond the surface. Because you know what most traders are looking for? What is commonly called, and pardon my French, trader porn. They're looking for, and so that's what they're looking for. They're looking for that sort of stuff. You know, people saying, "Oh yeah, I'm gonna make you a millionaire. You're gonna, you know, I made $700 billion last year. I own Ferraris. I have five girlfriends, and they're all models." That's what they're looking for. The Tim Sykes model. I don't know if you've heard of him. He's the one that actually kind of came up with it. So I have to compete against them, and they're 99% of them are scams. Unfortunately, sorry to say. I don't mean to be judgmental, but it's true. So, you know, right, you're right, KK. My work speaks for itself, but not really. You know why? Because that's not what they're looking. They're not looking for good, solid education. They're more interested in the other stuff. That's because that's what they think trading is about. They think trading, you know, is like Vegas. I mean, if you were going to Vegas to gamble, you wouldn't be gambling because you're trying to make $20, $50, or something like on a consistent basis. You're going there because you're trying to make $5,000, or, you know. Anyways, you get the point. So it's very hard for me to compete against these people, and I'm not gonna lower my ethical standards. I wouldn't be able to do it even if I wanted to. Um, and but that's what that's the kind of my biggest issue as a room moderator, or as a whatever, as a leader of your room. Okay. Uh, so I have a lesson that's available to you if you would like to stick around. I'll go ahead and record it now while you are here listening, and I'll actually recap the last lesson that I did. Um, so we'll do that, okay? But if you're if you want to leave, have a great night, and I'll talk to you in the room tomorrow at 9 a.m. All right? Uh, I know, Don. I know. Been there, done that, honestly, but that's not what that stuff doesn't make me happy. Okay? So I don't, I tend to not do that sort of stuff. Okay. Uh, Thanks, Nancy. I appreciate it. Okay, so I'm gonna broadcast this live, so let me go ahead and set that up. I have to set that up. So give me just a second, if you don't mind. It's gonna take me a second, but again, if you're you ask your questions, that's what you came here for. Feel free to uh, you know call it a day, and I'll see you tomorrow. Okay? If not, feel free to stick around. I'm just doing this for your benefit. I was gonna do it after I finished, but I thought I'll just do it with you while you're here. Okay, so I'm now broadcasting to YouTube, and now I'm gonna broadcast to Facebook. Okay, so give me 1 second here. Starting the broadcast to Facebook now. And I'm going to be live with you in just a second. For those tuning in on YouTube and Facebook, hi everybody. Welcome to today's lesson. My name is Sami Abu Saad. I am Director of Education at T3 Live, and I am actually doing, I'm in the middle of a coaching session for the Strategic Day Trader members. But today I am going to, let me reproject that, I'm going to share with you a lesson on candlesticks that will be really important for your success as a trader. While I'm speaking here, I am trying to fix the projector, and it's going to take me just 1 second. We started this lesson. It's a video series. Started this lesson last time on the weekend. So I'll give you a recap of the lesson number 1, which again we did on the weekend. We said that we use candlesticks, Japanese candlesticks, as opposed to Western bar charts, because candlesticks look at the relationship between the close, the open and the close of the same bar versus bar charts. Western bar charts look at the relationship between the today's close versus the prior period's close or yesterday's close. And we said that's not the right way to look at it, because if a stock were to gap, just like the market today, if a stock were to gap up here and then spend the whole day selling off to close at the lows, and yet it might have closed above yesterday's close, Western thought says this is positive, right? As long as the underlying stock closes higher than the prior day's close, Western thought says this is positive. However, according to the Japanese view, this is not necessarily the case. If on an up day a stock closes below its open, the Japanese would regard it as negative, because the Japanese view is that supply and demand is the most important element of technical analysis. And on a day like this day, where the stock might have closed lower than where it opened, that means that there was more supply than demand. And that's the most important thing to know when you're looking at charts, is whether there was more supply or more demand than supply. Okay, so we exclusively use candlesticks on all of our charts. Now, we also said last time that people really overlooked a simple, like a slide like this, where it's a simple lesson that says, if the candle is green and the stock closed above the open, it means that's bullish, it means the bulls won, right? They overlook something, they overlook the simplicity of this, but the truth is, the understanding candlesticks and what each candle means is the foundation to technical analysis. So you really need to understand candlesticks. We said in the first example here that the bulls were nowhere to be found. The stock opened here, closed at the highs. The bears were nowhere to be found. So all out bullish. But they weren't battle tested. Okay, that's the thing, is that maybe there are no bears at all around, or maybe they just didn't show up yet. We said number 1 is bullish, but number 4 is even more bullish, because the stock closed at the same price, closed at the absolute high, with a bottoming tail, meaning the bulls were actually tested. The bears showed up and the bulls still took them out, crushed them. So those are the two most bullish candles. Number 3 and number 5 are mostly sideways. Big tails on either side of the candle. That means there's a battle going on, but no one group is winning the battle. So mostly sideways. Number 2 is, even though it was a green candle, and if you bought it, if you were in that stock long, you would have actually made money because it closed above where it opened. We say this is a bearish candle because of the topping tail. The topping tail forms, the way it forms is this way. You have this stock opened here, rallied, right? But before the candle had finished forming, the bear showed up and forced prices lower to close in the bottom third of the candle. So the bears were the last group in control. That's important, right? That's important. But also the bears did a lot of damage. Anybody that bought it, over here, up here, up here, up here, right, is now underwater, is now sitting on a losing position. So topping tails trap people, and they definitely lead to lower prices. They put pressure on the stock. They create selling where there was none, right? So this is a bearish candle. I told you to remember how, last time you took a vacation, it might have been the most wonderful vacation, but if you had an issue at the end of the vacation where you missed your flight, you had some kind of an accident, you're never going to look back at that vacation and say, oh, that was a wonderful vacation, because the last part of it is always the most important. And it's the same in trading and technical analysis. The last part of it is the most important, most relevant. The set of red candles here is the same as green, but in opposite direction, obviously. So bearish, right? So number 7 is bearish plus battle tested. So number 7 is more bearish than number 6, presumably. 8 and 10, mostly sideways, neutral. And number 9, even though it was a red candle, meaning the stock opened here at the top, closed here, the bulls were in control towards the end, and they forced prices to close near the top. So that's actually a bullish candle. At the bottom, the body of the candle is black, meaning there were no, meaning it opened and closed at exactly the same price, but the two candles here at the bottom are the complete opposite. One is a bottoming tail, which is very, very bullish. One is a topping tail, which is very, very bearish. We also said that number 1, the first candle, is you have to know how it formed. Did it form on the smaller time frames? So if you want to know how this candle really formed, check the smaller time frames. Did it form after multiple bars up, like so, which leads to exhaustion? Or did it form like so, by breaking out perhaps and then going sideways, or by going sideways and then breaking out? So in order to really understand how the first candle formed, this wide range bar, you have to look at the smaller time frame. The bottoming tail almost always forms the same way. You get the red bars, and then the red bars get reversed. The faster the reversal is, the quicker it happens, the more bullish it is, because it leaves people with not much time to exit. It traps people. Whereas if it goes up slowly like so, then people have plenty of time to exit. But when it happens really quickly, then they get trapped. So bottoming tails also, if you want to understand how important, how strong they are, you have to look at the smaller time frames. Now, in this lesson, we're going to talk about wide range bars. We're going to talk about, I think, the reversal and the potency of reversals. We'll talk about that next time. But in this lesson, we'll talk about, let's go here. So in today's lesson, part 2, we're going to talk about narrow range bars. We're going to talk about topping, bottoming tails, and we're going to talk about wide range bars. Again, do not overlook or disregard this information. I know it's simple, it's not sexy for sure, but it is really the foundation all else is built upon. Okay? And narrow range bars and narrow bodies, bars in which the body of the candle is small relative to the overall length of the candle. They may have tails on either side of the body. While there are different variations, the message is always the same: a slowing in momentum has occurred. Okay, so you might say, well, that's not that important. Slowing in momentum has occurred. But stick with me for a few more minutes, okay? Stick with me for a few more minutes. We're going to talk about this in more detail. Wide range bars, a bar in which the candle's body is relatively wide, that's a wide range bar. Those two are wide range bars considered. Compared to the most recent bars. So a bar in which the candle's body is relatively wide compared to the most recent bars. The rule is they have to be at least 1.5 times the average sized bar. Again, at least 1.5 times the average sized bar. A wide range bar, after a period of low volatility, sideways base, ignites momentum in that direction. We call that a professional igniting bar. That's a brand new breakdown which should lead to lower prices. However, a wide range bar after an extended sell-off and after an extended advance or decline typically happens near the end of the move, because that, in this case, the wide range bar signals the exhaustion, right? It signals the panic. So why do we get a wide range bar after multiple red bars in a row? Because people are panicking out of the trade. That's why. Why do we get a wide range bar after the stock is up a lot and then you get a wide range bar? Because people can't take the pain of not being in it anymore, and so they jump in. For example, we had a few Climo plays today in the room. I personally did the VIAB. See this? Why did the stock start printing wide range bars? VIAB, because people started getting really greedy. So when I see that the stock is up a lot and prints wide range bars, I'm looking to fade it. How am I looking to fade it? Here it is. A narrow body signals the turn. I got the narrow body short under the bars low. Does that make sense? This was a trade that was called and played in the strategic day trader room today. Not just this, but I didn't do it. My co-moderator did it. I actually found the trade, but Mark called it. Here it is. ZS. It didn't print any wide range bars, but it had the reversal bar, that narrow body, that narrow range bar in this case. And so that was a Climo short also. How about the CRTO? I didn't do the CRTO either because it's a foreign company, it's a French company, and there's some brokers, some clearing firms add a tax on it. So on the transaction. So that's why I didn't do it. But it bounced okay, bounced a good amount. Notice it didn't print a wide range bar, so it wasn't as good or as clear as the VIAB, and that's ultimately why I did the VIAB short. Okay, so wide range bars, there are two uses for wide range bars. One is to ignite, to start new trends, and the other use is to signal the end. Which one of the two do you think is more useful? And strategic day traders, we are in the coaching session right now. Feel free to also type in your answers. This is for you as much as it is for the Facebook and the YouTube people. Which of the two wide range bars is more useful to us as traders? The igniting wide range bar or the exhaustion, the wide range bar that signals the end? Which one is more useful usually? Come on, guys, you know it. Strategic day traders, you know it. Anybody want to participate? Yes, of course, the one that signals the end, exactly. Took you guys a second, and now you're all typing the same answer. Yes, the one that signals the end, because the one that signals the start of the move, if you're not in it here when it was still a small bar, let's just say you didn't get in it here, you can't get in it there. It's already too late. But what you can do is look for the next entry, which was right here. Short, stop right there. That's it, called a sell setup. So does that make sense? So the igniting is not very useful unless you get a secondary entry right here. But what if the stock dropped and just continued? Then it was of no use to you because it's gone. Whereas the exhaustion bar happens, when you see it, you still have the time to get in because you're actually going against it. You're fading it. So for sure, the exhaustion bar is more important. So now you learned something really important about wide range bars, which are called the footprints of money, which are basically the sign of big money going into a stock. And that is they either ignite, start new trends, or they end old ones. Okay? Now, what else did you learn? We also learned that narrow range bars usually form after wide range bars, which signal the turn. If it's an exhaustion wide range bar, then that you want to play long above it, above the narrow range bar. Think of a narrow range bar as a car driving and trying to make a U-turn. You gotta slow down to be able to make a U-turn. Does that make sense? So here, when this stock was trying to make a U-turn, it had to slow down, so it printed the narrow range bar. When it doesn't print a narrow range bar and just goes like this, big red bar, then you can't get in it. So we usually look for narrow range bars after exhaustion bars, so they can give us the entry. Entry right here, stop right here. Entry right here, which was 29.11, right? Stop right here, which was 29.33, I believe. See this? 29.11, 29.33, because I took this trade. Okay, now when it's an igniting bar, we also look for narrow range bars because you can do the 1, 2, 3. Igniting, doji bar or narrow range bar, and then you can do a 1, 2, 3 if it breaks under it. In this case, we did kind of get a narrow range bar, but it didn't break under it, went higher, which was fine because it gave us a sell setup. All right? Okay, so moving on. Topping tails, normal or wide range bars in which prices had been higher than supply forced prices to close below the midpoint of the bar's range. So now we learned at least one new thing about topping tails, and that is topping tails, a bar is not considered a topping tail bar unless the tail makes up at least 50% of the candle size. So a topping tail is only valid if it makes up at least 50% of the candle size. While there are different variations, the message is always the same. Distribution has occurred. Distribution means selling has occurred. And overhead supply has been increased. Why is that? Why do you think overhead supply had been increased? Anybody? Why do topping tails increase supply? What the hell does that mean? Anybody? And then the other thing I want you to know is the most potent tails will have a wider range than prior bars, will also be wide range. So it's a wide range bar from top to bottom is also a big bar. The bigger the tail, the more resistance, the more supply. Okay, it increased supply. A topping tail actually increases supply for the reason that we discussed earlier. A topping tail, the way it forms is the stock is moving up and then all of a sudden gets slammed. Sorry if I scared your cats and dogs, but you get the point. It's moving up nice and easy and then gets slammed. So people get caught. So all of the people that bought it on the way up now here are going to be underwater. So they're going to be looking to sell the stock, especially if it starts to break down. These people were probably just entered. They weren't looking to sell it. So there wasn't supposed to be any supply here, but the topping tail actually created new supply where none existed before. So that's why we say overhead supply has been increased. Does that make sense? That's why we say overhead supply has been increased. And the bigger the tail, the bigger the supply. Bottoming tails are the same, but in reverse. Normal or wide range bars in which prices had been lower, then demand forced prices to close above the midpoint of the bar's range. While there are different variations, the message is always the same. Accumulation has occurred and demand has been created because the shorts, anybody that shorted, is now trapped. The shorts are going to look to cover, so new demand has been created. And the most potent bottoming tail bars will also have wider range than normal. And those are called range expansion. If a bottoming or a topping tail bar has above average range, at least 1.5 times the size of the average bar, it's called a range expansion bottoming or topping tail. And that, my friends, is the single strongest reversal sign you can get. It's the strongest reversal bar that you can get. Now, a narrow range bar or narrow body is a bar a narrow body bar is a more reliable indication of a turn after a wide range bar. It's only reliable when you actually have a turn, if it happens after multiple bars down, 3 or more usually, especially if the last bar was a wider range. So the difference between a narrow range or a narrow body is a narrow range meaning from top to bottom the range is very narrow. Narrow body means the body is narrow, but the range is not necessarily narrow, it's average. This one is what I call the battle bar because it signals that there's a battle going on. A narrow range bar, a bar that is smaller than normal, doesn't really signal much of a battle. So I like the ones that have big tails on either side with a narrow body. Those are my favorite reversal bars. Okay, my favorite reversal bars. So continuing on, we were on this slide. Without an increase in volatility, odds of a reversal from a narrow range bar are slim to none. A narrow range bar, in essence, means low volatility. So unless you have an increase in volatility and the U-turn, that narrow range bar or narrow body, it's meaningless, really. It just means a slowing in momentum. Wide range bar. A wide range breakout or breakdown after a consolidation ignites a move in that direction. A wide range red bar followed by a wide range green bar and vice versa are powerful reversal signals. These are called bull or bear sandwiches. So a wide range red bar reversed completely by a wide range green bar. That's a really bullish signal. Or a wide range green bar completely negated by a wide range red bar. Very, very potent. Range expansion, we talked about them. The bottoming tail or topping tail may or may not be a range expansion. It needs to be a wide range. It needs to be wide range in order for it to be called an RE bar, a range expansion bar. A wide range bar or a range expansion bar displays commitment and emotions, right? A lot of people committed to the stock. A lot of people committed a lot of money usually. So it shows the level of commitment and of course emotions. We said wide range bars serve two purposes. They either signal the end of the move if they happen after multiple bars down or multiple bars up. See this on the right side of the page. So they signal the end, the exhaustion. Expanding range after a multi-bar move indicates fear or greed is increasing and becoming extreme, increasing the odds of a reversal, and that's the most useful thing about wide range bars. But they can also ignite. When you have a wide range bar that starts at the beginning and then you have small bars at the end, what does that mean? It means momentum is slowing, but fear is not extreme, which means we should still continue lower. So check this out. Here, if you were to ask me, are we going to continue lower? I'd say probably not, but we're probably going to get a reversal. If you were to ask me, are we going to continue lower? I would say momentum is slow, but we should continue lower eventually at least, because there's no exhaustion, there's no panic. We didn't get a wide range bar. Does that make sense? So momentum is slow, but it's not trends don't reverse for no reason. Trends typically continue. So trends don't reverse unless we get a wide range bar, usually. So without a wide range bar, the odds are with the trend, not against it. And the same here, right? The same here. Greed is not extreme, right? Fear is not extreme. Whereas here, greed is extreme. And so it's easy to get a reversal and then a playable reversal, actually. I hope you enjoyed today's lesson. This was done in the coaching room and broadcast live to Facebook and YouTube. I hope you enjoyed today's lesson. We have an incredible offer going on where you can trade with us for 30 days for just $49. You can check out the room where you can expect this level of knowledge, this level of education, and much more, of course. And you can expect to get plenty of calls every day. I was telling the students in the coaching room that it's my job as a as a room moderator is to showcase you guys the methodology that I trade and what we do in the room. But I have a hard time doing it because I'm not a sales guy by nature, and I have to compete against all these scams out there, unfortunately. But what you find if you join the room, the strategic day trader room, is that we're the real deal. Okay, we're real traders with real knowledge, as you can tell, and we hold nothing back. So highly encourage you to take advantage. It's only 49 bucks. It's basically free, if you ask me. $49 for 30 days, and you get all the plays, the ideas, the watches. You get to be part of a room with incredible education, incredible community, and you get to be part of the best trading room. We won the award for being the best trading room 2 years in a row when Trader Planet was running that contest, which was voted on by the trading public. So again, hope you enjoyed the lesson, and I will talk to you on the next video. Have a good night, everyone. And I am done broadcasting. So thanks for sticking around, guys and gals. I hope you enjoyed that lesson. It was, again, that's all the advertising that I do for the room is I do these lessons. But as you can see, it's good stuff. I'm not wasting people's time. I mean, it's really good stuff. And just hope that that they like what they see and they find benefit in it and they decide to join. So thanks so much, guys. Have a wonderful evening, and I'll see you tomorrow. Take care. Good night.